So I assume, and I pretty strongly assume, we're going to have a recession sometime in 23. I just don't know whether it's going to be in the early part or the later part. And again, it's a guess, it's not a fact.
The investor that you just saw in that clip, that's American investor and hedge fund manager Stanley Druckenmiller. He recently talked about the current market environment, the big upside surprise in inflation. Current official inflation is now 8.5%, the highest since December 1981. The big downside surprise in consumer sentiment, which dropped in early June to its lowest level since the early 1980s. The risk of a prolonged bear market and the likelihood of a recession in 2022 or 2023. The interview took place during the 2022 Sohn Investment conference, where Druckenmiller was interviewed by John Collison, the co-founder of Stripe. So let's break down what Druckenmiller has actually said and what you as an investor can learn from his view on the current market environment and the opportunity set available to investors. Alright, hey there, my name is René Zellman, and what I will do in today's video is I will show you a couple of short clips from the interview with Druckenmiller, and then I will add a few of my own thoughts on the subject at hand. So let's start by taking a look at what Druckenmiller has actually said about the sell-off that we are currently seeing in the US stock market and actually in stock markets around the world, with the S&P 500 being down 19% year to date, the Dow Jones being down 14% and the Nasdaq 28%.
The bubble has really burst with a vengeance, a lot more than you can see in the S&P. A lot of very good companies have been derated 60–70% without a whole lot of change in fundamentals. So valuations have improved relative they were. And then
so what Druckenmiller is talking about here is a phenomenon that I have actually addressed in previous videos as well. Namely the fact that the current drawdown is actually much more severe than what you can see in the broad market indices like the S&P 500, for example, or the Dow Jones. Sure, the S&P is down around 19% year to date. However, this does not really reflect the true carnage that has taken place under the hood of markets. So this graph here from early April, for instance, it shows that while the Nasdaq index was down around 14% at that point, more than 45% of stocks were down more than 50% back then. 22% of stocks were down 75% or more, and around 5% of stocks were down 90% or more. And again, this graph is more than 2 months old, and the decline of individual securities as of today is actually much more significant. So if you have access to updated data, please share your insights in the comments down below. So of course, prices were elevated in 2021, and with many stocks being down 50, 60 or 70%, valuations have basically reset. And thus, if the fundamentals of individual businesses are intact or even improved over the last year or so, you are much more likely to find attractive investments, attractive entry points today than you were a few months ago. Alright, so on to the next clip of Druckenmiller. Here Druckenmiller talked about where he thinks we are in the current bear market and whether investors should expect further price declines.
I would just say, where are we now? It's hard to believe, given the extent of the monetary policy the last 10 or 11 years. I think globally we had 30 trillion of QE. Even as late as, I think a year ago, there was 18 trillion of debt that was still negative yielding when the world was about to experience 8% inflation. It's pretty extraordinary. So it's hard for me to believe you could have unwound all that created in terms of a misallocation of resources in 6 months. So my best guess, and this business is about guessing, there are no certainties, is that we're 6 months into a bear market that has some room to run. For those tactically trading, it's possible the first leg of that has ended. But I think it's highly probable that the bear market has a ways to run.
So, according to Druckenmiller, it's highly probable that the bear market has a ways to run. Ouch. The current sell-off has already been very painful for many investors, and growth investors in particular. Many are down 30 or 40% year to date. And Druckenmiller thinks it's not over yet. In a way, what he was saying reminded me of the 2/3, 1/3 rule. According to this rule, about 1/3 of a stock's market decline during a bear market occurs in the first 2/3 of a bear market's duration. And then about 2/3 of the decline occurs in the final 1/3. This was the case in the bear market of 1973, and a similar phenomenon could be observed during the decline of the great financial crisis around 2008. And this may be why Stanley Druckenmiller himself is doing very little right now. Later in the interview he said, "Currently I'm going in every day and I'm looking at my screen, but I'm pretty much taking a break, waiting for a fat pitch." So here I think he's talking about the idea or the philosophy that I'm also a big proponent of. I think having the ability to reject ideas quickly makes you a much better investor. I truly believe that it is your job to reject ideas quickly and to focus on the few opportunities that come along maybe 1 or 2 times a year and that are actually so-called no-brainer investments. And this brings us to maybe the most interesting clip from that interview that I wanted to share with you today. In it, Druckenmiller highlights 2 undefeated historical track records. Have a look.
Well, the answer is I don't know, but the probabilities of it being a soft landing are pretty remote, John. Historically, I think we've only pulled off 2 or 3 in history. The one I lived through and remember so well was the 94-95 one, but we've never had a soft landing after inflation's gotten above 4.5%. And the situation we face now is extraordinary, where the Fed, where are we these days? I guess we're at 75 basis points. I can't keep up. But even the projections of 2%, you're so far behind the inflation rate, and there's so much wood to chop, and there's been such a broad asset bubble going into it. It's very hard for me to say that the probabilities favor a soft landing. Indeed, I think they aggressively point to a hard landing. Anything's possible. As I said earlier, I've been wrong plenty of times in my career, but betting on a soft landing to me is a real long shot. There's an interesting historical fact, which in fact I think is going to be violated, but 2 undefeated records are: number one, once inflation gets above 5%, it's never come down unless Fed funds have gotten above the CPI. Well, since the CPI is 8, that would call for a Fed funds rate of above 8. Frankly, I don't think we'll get there because the extent of the asset bubble and the damage that would be done. The other statistical fact is once inflation's got above 5%, to use your word, it's never been tamed without a recession. So if you're predicting a soft landing, you're going against decades of history. Could happen, anything's possible, but I don't think it's probable.
So the 2 historical facts that have undefeated historical track records are, first of all, that once inflation gets above 5%, it has never come down until the interest rates set by the central bank, so the Fed, are greater than the measured change in the CPI, so Consumer Price Index. And secondly, that once inflation is greater than 5%, it has never been tamed without a recession. And as most of you are probably aware of, as of May 2022, inflation is at a record level of 8.6%, and we can actually see a constant acceleration of inflation over time. And as we can see in this graph here, with the Fed funds rate at around 75 basis points, the Fed is absolutely behind the curve, which is a way of describing a central bank that is not raising interest rates at a pace fast enough to keep up with inflation. Effectively, we are seeing real interest rates of around -8%. And again, to explain the terminology here, a real interest rate is basically adjusted to remove the effects of inflation. So to calculate the real interest rate, you need to subtract the actual or expected rate of inflation from the nominal interest rate. And by the way, the European Central Bank is even more behind the curve. Inflation across the 19 member euro area is expected to be 8.1% in May 2022, up from 7.4% in April 2022, and consumer prices in Germany, the continent's biggest economy, jumped 8.7% from a year ago in May. And the ECB's, so the European Central Bank's, main policy interest rate is still currently at 0%. Alright, to get back to Druckenmiller. Druckenmiller later said during the interview that increasing interest rates, increasing oil prices and a strengthening of the US dollar, this combination has always resulted in poor corporate earnings. And Druckenmiller's sentiment that interest rates are destined to go up and will eventually lead to a recession was actually shared by his fellow investor David Einhorn from Greenlight Capital. He was also interviewed during the Sohn 2022 investment conference, and he said that it is monetary policy 101, that to defeat inflation you need positive real interest rates. In 1980, Volcker raised rates to 19% to combat 14% inflation. Greenspan raised rates in 1990 to 8.5% to fight 6% inflation. Today we have real interest rates at the most negative level in the last 70 years. And you can see in this graph here, when inflation was very high, Volcker reacted and dramatically increased interest rates, which in turn was able to bring inflation down over the next 2 to 3 years. But at the cost of the 1980 to 1982 recession, in which the national unemployment rate rose to over 10%, and it was actually the worst economic drawdown since the Great Depression, only surpassed by the 2008 financial crisis. But again, the Federal Reserve Board, led by Volcker, was able to tame inflation, which had been weakening the US economy since the mid-1960s. And by the way, stocks were also performing very poorly during this period. The Dow Jones was basically flat between 1966 and 1982. So, without Volcker's bold change in monetary policy and his determination to stick with his plan through several painful economic years, the US economy, may have continued on its downward spiral. Okay, and that's it. If you have the time for it, I think it's well worth listening to the entire 70-minute interview with Stanley Druckenmiller. And if you want to watch it, just click here. Take care.